These webinars are a part of our knowledge sharing collaboration with the Global Action Network, which is supported by the USAID, and the BASIS I4 program at the University of California at Davis and the Global Index Insurance Facility of the World Bank. We've been discussing various aspects related to agriculture insurance, and today's webinar focuses on an important factor, the role of the government. Following up from our last webinar, today we look at how governments have actually influenced the growth of agriculture insurance markets and share a few implementation experiences. Before we go down to the webinar itself, first let's quickly familiarize ourselves with the webinar system that we'll be operating. What you would be seeing on your screen and in the webinar system is something like this that's on the slide, wherein you can actually interact with the system and with us too. Besides hiding and unhiding the control panel so that you can get a better look at the slides, you can also share your views and talk to us by typing the question in the chat box which is indicated in the slide itself. You are currently all in the muted mode just to prevent any background noise and disturbance from coming in, but please feel free to type your views, comments, questions, queries, clarifications in the chat box, and we'll try to respond to them either in the question and answer sessions or even during the presentations being done. We also want to keep hearing from you and get your views on the topic itself, for which we will open polls during the webinar, for which we would request you to respond, and you can participate in those polls by simply clicking on the answers that will be displayed on your screens. Please do take care that the polls will be open for very short periods of time, so respond to the questions with whatever your impressions are. These polls are multiple choice, you just have to take a choice there. So we look forward to constantly hearing from you during the webinar. On the topic itself, to share the implementation experiences and interactions with the governments, we have an exciting panel of presenters who represent a cross-section of organizations from across the globe involved in actual implementation of projects. Tara Steinmetz is with the University of California in Davis, in California of course, a university that is dedicated to agriculture, and Tara works for the BASIS program and the Index Insurance Innovation Initiative and has been intrinsically involved in seeing the impact what agriculture insurance, index insurance has been creating across various projects across the globe. Mathieu Dubreuil brings in a development sector perspective from the World Food Program and has been a long-standing proponent for index agriculture insurance, earlier with Planet Guarantee and now driving the R4 program with the World Food Program. We look forward to hearing more about these programs in the presentations. And then we have Vivek Lalan, who is working with HDFC Ergo in India, which is a leading private sector insurance company working closely with the government of India for agriculture insurance programs and has seen the growth of agriculture insurance and the public-private partnerships as they are being implemented in the country. So we look forward to a fairly rich array of thoughts and ideas in the next 60 minutes or so, and we hope to respond to some of the interesting issues that will come up during the webinar and on queries that you may have. Before I hand over the floor to Mathieu to start and share with us what the World Food Programme has been concerned. Let's take a quick recap and understand from you what you all feel about what the governments can do and what governments are best suited for. So we will have our first audience poll now, wherein the question is, governments are best suited to scale agriculture index insurance by A, creating a facilitative framework, providing straightforward premium subsidies, involving themselves in developing a platform for consumer education and ensuring dissemination happens, or D, by directly being players in the insurance market and purchase insurance for safety nets or catastrophic covers. What would be, according to you, the best role the governments are suited for? Please respond by answering the question now. You can go up to 2 choices in this, so feel free to take more than one, but no more than 2. Aha, we are getting some interesting responses. 5 more seconds for the poll to be open. Can we please close the poll now? As we see, the House is fairly divided on the various roles that it sees the government playing, but one of the most important roles, it seems, that the government can create a facilitative framework and having a role to play in getting an environment and creating an ecosystem which can allow the insurance markets to flourish. So let's see what our panelists have to say on this and what their experiences have been in this regard. So I'll hand it over to Mathieu from the World Food Programme to share their experiences in implementing a large insurance program connected with other risk mitigation techniques. So over to you, Mathieu. You have control now.
Thank you very much, Pranav. Good afternoon, everyone, at least for those who are in Europe or in Africa. I will mostly speak of our experience with the R4 initiative of the World Food Programme and Oxfam America in Senegal and in Ethiopia, provided that we are also operating in Malawi and in Zambia. Just a quick I just wanted to highlight first that the interaction that we have with the government and the way that we're seeing it may be slightly different from a pure commercial microinsurance approach and has a strong social protection insights. So this is something that has to be kept in mind, I think. So yes. So about the R4 model in Senegal in general, the R4 model is initially based on the social safety net programs that are available in the country, being led by the government or by the World Food Programme or any other stakeholder. In Senegal, it's actually based on the tool that we call food assistance for assets, which is basically having the most vulnerable communities working on asset creation, and in exchange of their work, they are receiving food or cash. So this is the first component of R4, that is the disaster risk reduction. And then we're having 3 others. Let's say that the most innovating one is the risk transfer, on which we are mostly basing the index insurance products, and I will come back on that just after. And 2 others that come to complete the picture and the resilience building, the climate adaptation approach, that are the risk reserves, so basically developing savings amongst the communities, and the prudent risk-taking to help households to improve their livelihoods during the good years. And so these four components for the community and for the household, not specifically for the individual, are supposed to help the communities becoming more resilient, then moving and graduating to something slightly more productive and improve their livelihood and income. In Senegal, we are mostly working on the insurance component with some key stakeholders, CNAS, which is the National Agricultural Insurance Company. I will talk about them a little bit later. Pledge Guarantee, that is a microinsurance broker and has a management platform for index insurance. Some saving groups, associations that have been set up by Oxfam America. La Lumière, that is an NGO working on community mobilization, and IRI from Columbia University that is helping us designing the indices. And we also work on other rural development projects, in particular some USAID project called PMFBY that is working on some key value chains like maize, rice, and millet, and some IFAD and public programs working on some other value chains, but with which we are trying to build these graduation processes, which is very key because we expect that R4 is helping graduating participants and beneficiaries. So in Senegal, we do work with two types of indices. In one region, we work with satellite index based on rainfall estimates. For those who know, we use the Ergo data, and it's a very simple index with two windows only. So we do not cover the entire season because IRI has proven that in some cases and in many cases we were able to actually better capture the key worst years that were experienced by farmers and communities with only two windows, and make some indices that are more simple than the three indices really designed for one specific crop. And also because we're working with very vulnerable farmers that are not exactly professional and productive farmers, we are non-crop specific indices in the Tambacounda area. And for this reason, the satellite and the rainfall estimate really do make sense. In the south of the country, on the other hand, in order to not multiply the number of indices in the same region and keep the messaging to the communities simple, we decided to cooperate with Pledge Guarantee, CNAS, and some other project to use existing ground-based indices for maize and rice. So as I was saying, we do work with vulnerable population that are food insecure, usually not chronically food insecure, but they are heavily, highly exposed to climate shocks. And this is really the core of our target populations, which is always, as you can imagine, difficult to target very specifically, but this is how we select the villages. And so we know that it's very difficult for farmers, especially during the lean season, to have the cash to buy the insurance product. And for this reason, and I have to mention that the idea comes actually from a farmer in Ethiopia. The idea is that we design the insurance for asset approach, meaning that farmers and the communities can work a few additional days, and in exchange the R4 programs pays the premium to the insurance company for them. We of course have progressive phasing out so that farmers increase their cash contribution over time, and in the end, we expect them to be able to pay entirely the premium. So our experience with the Senegalese government and all the public bodies are quite wide. First, in Senegal, the state subsidizes all agricultural and livestock insurance premium by 50% and apply no taxes on the product, which is really really useful to increase the sum insured first, but also to improve the, and also to lower the premium level. There is also a very strong risk management policy in rural areas that the government is trying to apply by trying to lower the risk exposure of rural communities, but also when the government was among the 4 first states to join the ARC policy 2 years ago, which actually received a first payment the first year that was then redistributed to some parts of the country, including the part of the country where R4 is actually working, although we don't have operational linkages so far. CNAS is a very interesting instrument that was set by the government in 2008 with part of the capital owned by the private insurance companies and part by the state himself. And CNAS has a clear mandate to work in rural areas and to provide insurance solutions to rural communities. So they first, and they still focus mostly on agricultural insurance and livestock insurance, but they are also starting to think of how they can also provide additional insurance solutions and micro-insurance solutions, in particular on health and life insurance. Then we have a very dynamic insurance supervisor that is that has a strong involvement in a sectoral tool that was initially launched by WFP and CNAS, which is called Comité pour le développement et la promotion de l'assurance indicielle, that's Committee for the Development and Promotion of Index Insurance, that is regrouping all operational, technical, and financial stakeholders in the sector that are interested or operating on index insurance in order to share information and to work on the key issues that the country is facing. And we have actually improved and built synergies in a very efficient way in already 1 year. Also, there is a microinsurance regulation that was supported by the World Bank in the CIMA region with one book dedicated to microinsurance and some decrees specifically on index insurance. It's not perfect, but at least it gives us a good framework on which we know where to go. Then we also cooperate with the Met department on several levels. First, on providing us the rainfall data. We have also installed with the other projects more than 50 automated rain gauges, and so the Met department is also running them. It's not always easy, to be frank, because increasing that much in some small areas, all the the network of the Met department without increasing so much and on a long-term basis their income and their financial resources to actually maintain this network. This is causing challenges, and so the whole sector is currently trying to think of a strategy on how we can sustain this, because they have definitely a key and long-term role on that. As the R4 initiative, we do also work with the local government. Initially, we try to work at larger scale with the, let's say, with the main ministries, but we didn't find like the right angle. Was it about climate change and climate adaptation with the Ministry of Environment? Was it rather with the Ministry of Agriculture and Building Resilience? it wasn't so clear, or was it about social protection? So we decided to actually drop it and to rather work with local governments in Tambacounda and Kolda, which was pretty efficient to actually coordinate the asset creation and the coordination with all the other initiatives. We had some informal coordination at the Prime Minister offices with his advisor, but there was nothing completely formal and let's say long-term, so I don't think it was actually that efficient. But building with local government helped us after to really rebuild the relationship with the Ministry of Environment that we are rather targeting now. And just to finish on that, we have built with IRI an index design team because we think that Senegal has to have its own capacities to design and maintain and monitor the indices at local level, and that we should maybe not always work with international consultants or researchers. And so we built this team with CNAS, with Med Guarantee, with the Med Services, and an institution of agronomy and research called ISRA. And within a year, we came at some improvements. The situation is still not perfect, but I think at some point we will manage to have like fully autonomous capacities there. So I spoke about the finding the right institutional linkage, which was very, very important. But also there was this issue. I mean, right now I think that the total portfolio of index insurance in Senegal is maybe about 12,000 people insured, in which we may have 7,000 with R4. Well, maybe we are at 15,000, I'm not exactly sure. But the Ministry of Agriculture was not exactly understanding the tool of the insurance company and was not understanding why they were not managing this tool. Because as an insurance company, they were under the Ministry of Finance. And so CNAS was not completely involved in the process and in the policy that the state was implementing. And for this reason, the portfolio of CNAS was not scaling up fast enough. And now they've been included in it. So we think at the sector level that we should that it will actually speed up. Yes, Pranab, I'm speeding up. I'm sorry. Maybe about Ethiopia, I'm just gonna skip most of it, but the main difference in Ethiopia is that the government is actually managing and running the productive safety net program, so the social safety net basis, and WFP and Oxfam are actually only running the insurance for assets process, which is great because it's a fully social protection system on which we can really build upon. And we are actually trying to include the insurance for asset in this PSNP. That gives us a very strong coordination with all the other disaster risk reduction initiatives and all the conditional transfer activities. But something that I wanted to mention about Ethiopia is that it's taking time, and so right now the Ethiopian government has not, let's say, taken over the insurance for assets in their social protection policy because they are still learning about it. Although we have about 30,000 people insured in the country, in the north of the country. But if we consider the Food for Assets initiative that was actually first implemented in Ethiopia 20 years ago, it took quite a while to actually be fully understood and by the Ethiopian government. And then this program was actually turned into the PSNP, so it became fully public. So it took about 15 years to actually become something completely taken over by the government. And so one of my key lessons would be that the patience is key also for us as non-public stakeholders. In terms of key messages, and I'm going to be a little bit fast on this one, so I think we can have like various ways of partnering with the government, something very direct as we're doing in Ethiopia, and something less direct and more, let's say, about coordination and so on, like what we're doing through the CDPI in Senegal and with the insurance company. I think also that it's going in two ways, meaning that your project or your business has to be included in the government's policy because we are working in development in developing countries, so we are having like long-term goals, and at the same time we need to make the government understand that they need to put in place the right framework, as you all mentioned, to help you scale up your business and your or your projects. It's obvious that the government has to become convinced, and the more it will be active and support measures to make the project sustainable, the more you'll be successful. And so for that, it requires obviously continuous training at different level of the state, at ministries level, at field level with all the different agencies, but it's not in 3 days training that you will achieve that. And you also need to prove the evidence, and this is actually for, let's say, the project or the businesses that are supposed to become public. You need to show that your tool or your approach is actually cost efficient and has some impact for the population that you are targeting. There are some issues on which you actually need to work not on your own but at the sectoral level. For instance, we were still discussing with the government how we can run the Med department, relationship, how we can optimize that and optimize the public money that is invested in Senegal. And so this is actually now taken over more and more by the committee that we put in place with all the stakeholders. And I think that's really the way it can be efficient. And last but not least, it doesn't mean that if you have a good relationship with the government, you shall not advocate for improvements. So for instance, the subsidies mechanism in Senegal is great, but it could be so much more efficient and also cost efficient for public money that we're still advocating for an improvement at this level. So I will stop here. Thank you very much, and sorry I've been a little bit long, and I hand the floor to you, Pranav.
Thanks, Mathieu, for sharing all these points and highlighting the importance of having the insurance program within the social protection network and the social protection angle to it. Also, the challenge of working with multiple government players and multiple ministries to work with, as well as the fact that the engagement with the government can take time and it evolves over a period of time. So let's move the focus on to India now, where we perhaps see ourselves adding a couple of more zeros to the figures that Matthew's shared with us. And I'd request Vivek to now share some of the experiences that have been seen in India and how the government has played an active role in helping index insurance scale up. So over to you, Vivek. You have controls now.
Thank you, Pranav. Hello, everyone. I wish to start here by introducing Indian agricultural landscape to all. So the contribution of this sector in GDP is around 14%, which is obviously way less than one at the time of independence. That is around more than 50%. But still, the sector is pretty relevant for the country, as around 50% of the workforce and around 70% of the families are directly or indirectly related to agriculture sector. The condition of financial inclusion and advancement of technology in agriculture is supporting the growth of sectors. Still, agriculture in India is heavily dependent on weather. Now let's look a bit at the sales process in case of agri-insurance. Government is highly involved at all stages of this process. It starts with the notifying of the scheme, selection of the crops, area, and selection of the insurance companies, then promotion of the schemes to the granular level, and bundling of the insurance with loans, and then finally claim settlement. So government is practically involved at each and every level of this particular process. In last 50 years, the crop insurance in India has evolved as a concept. The initial programs, right from 1965 to 1999, were basically more focused on few states and were more of a compensation kind of schemes. Year 1999 marked a structured step in the field of crop insurance when government established Agriculture Insurance Corporation of India, the company focusing only on agriculture insurance. National Agriculture Insurance Scheme, that is NAIS, was launched in the same year, and crop insurance was made mandatory for all the lowly farmers. So basically, that's the difference between the CANAS model, which Mathieu talked about, and AIC, that the insurance was compulsorily bundled with the finance, and the government effort in the field was materialized while formation of AIC. Now, NAIS was basically a yield-basis scheme, and claims beyond 100% were shared by the governments. So it's basically subsidized at the time of claims. Year 2007 brought concept of weather insurance in the Indian insurance market. Also, the year marked entry of private sector in the field. So weather-based crop insurance scheme became a full-fledged scheme in 2009, and again a new improved NAIS, that is Modified National Agricultural Insurance Scheme, was introduced, and private sector was allowed to implement both the schemes in the country. Now, PMFBY, that is Pradhan Mantri Fasal Bima Yojana, that is the current flagship scheme of the country, is introduced in this year 2016, and all the previous schemes are being scrapped. So currently India has two schemes implementing. One is yield basis PMFBY, and second is index basis weather-based crop insurance scheme. Now, I would just like to throw some light on PMFBY, that is the flagship insurance scheme of the country. The scheme is yield basis with some additional coverages like insurance against localized calamity, hence taking the insurance from area approach to plot level. Actuarial premium is introduced, but still insurance has become more affordable as the premium is hugely subsidized here. The maximum premium paid by the farmer is hardly 2% of the sum insured. So there's a grand plan to use modern technology to enroll farmers, assess, and finally settle the claims. There's a huge use of satellite imagery which is going to come. There will be use of mobile phones for capturing the yield which is coming out of the crop cutting experiments. So obviously there's a flavor of technology in this particular scheme for the first time. The financial year, this financial year looks pretty exciting for insurance domains in the country. Suddenly, the crop insurance has become the third largest product line in the non-life industry. The market potential has obviously increased way from $800 million to roughly around $2,850 million. That is what we are expecting in this year. Now, as you can see, NAIS is scrapped and only two insurance schemes will be implemented in the country. The increase in market size is because of various factors. Obviously, there's an increase in the premium rates. The sum insured has also increased due to increased covered area and improvement in the finance, in the scale of finance. Lastly, government is hugely involved again in promoting the schemes to the farmer level. Hence, expected penetration of the crop insurance is likely to increase to around 35% from current 22%. This increased present penetration is owed to the joint effort made by insurance companies and the government to bring more and more farmers under purview of the scheme. The inclusion of private sector has ended monopoly and introduced competition. Hence, there is a huge change in marketing and promotion scheme strategy of the crop insurance. There are nationwide workshops which are being conducted by insurance companies jointly with administration and banks, and obviously the government, to increase awareness about the fundamentals of insurance and importance of this scheme. There's a huge improvement in infrastructure related to crop insurance. You can see the increase in number of automated weather stations, which was roughly around 2,800 in 2014. to around 7,500 in 2016, which is further going to increase to around 9,000 by the end of this calendar year. Currently, there are 16 companies which are approved for participating in agriculture insurance companies in this agriculture insurance field, and they are working in all the 29-30 states of the country. So this is basically an improvement where only 6 companies were actually implementing the agriculture insurance scheme a few years back. So currently the total number of companies who are implementing the scheme is around 16. Companies have launched their own agri-focused call centers, helplines to connect directly with the farmers. There's a huge effort to bring more transparency in the process of insurance, right from the enrollment of the farmers to claim settlement. Technology is becoming a major driver. That's all from India. Over to you, Pranav.
Thanks, Vivek, and thanks for sharing all these details with us and telling us how the government has played an important role in building infrastructure, allowing entry and encouraging entry of a lot of players to come in, and not only insurance companies but also diverse set of players such as data providers, technology service players, call centers beginning, and generally the government having a hand in propelling the private sector to participate in a field and in a sector that was traditionally not considered a very lucrative field to participate in. So also one fact about India particularly that I think is worth highlighting and about the openness of the government is that the index insurance schemes in agriculture essentially started out in the private sector in 2003-2004, and the government then saw some results there, interesting results, and then adopted it to make it a part of the policy framework in 2007 and then drove it onwards. So I think India presents a good example of how the private sector and the public sector have worked together in actually choosing a program and having it evolve over a period of time from pure yield-based to agri-based to index-based, then a mixture of them, and now the landmark Prime Minister Fasal Bima Yojana to ensure at least 50% penetration. So we look forward to tracking this scheme and hearing more as it develops. So be ready to communicate more with us, Vivek. Look forward to it. We've seen till now 2 examples of how governments have participated in having a voluntary scheme running in Senegal the way Mathieu talked about, and having now a compulsory bundle scheme with the loan side as we just saw in India, and they have had absolutely different kind of results. We've seen the premium growth in India moving forward. So at this stage, I think it's appropriate to ask the audience that yes, subsidies seem to be working, but what are the various ways in which subsidies can work? And can we have the second audience poll on now? So we'd like to hear from you participants on what you think is the smartest use of subsidies by the government. Is it to subsidize premium? Is it to build capacity for insurance by developing, should we say, a reinsurance pool or a reinsurance covers for companies to take more and more risk? Is it for creating an infrastructure for data collection and dissemination of information so that more and more people can create better products and more people hear about those products? Or is it utilizing the money that they have in providing and developing outreach to the customers and helping in the actual enrollment process? So we'll open the poll now, and you can vote again on two alternatives that you think the monies from the government can be best utilized in. For subsidizing premiums, buying large insurance catastrophic covers, reinsurance catastrophic covers, sorry, creating an infrastructure, or for providing consumer outreach. Okay, let's keep it open for 10 more seconds so that everybody can take a choice. Just a few seconds more. Thank you. Can we close the poll now and have a look at the results? Wow, our audience has been very consistent. Even in the first question they said that it's an ecosystem that needs to be created, and here also they're saying that the best use of the government money can be in creating an infrastructure, helping companies overcome the data challenges, looking at how overall pools can be created for companies to take greater risk, as well as, to some extent, and that's what 30% of the audience seems to be saying, is providing customer outreach and subsidizing premiums. So thank you, audience, for this very nice response where you've shown us and told us that the best way may not just be to subsidize premiums, but also to do a lot more than subsidies, which can help create an environment and create an insurance culture overall. So let's try, thank you very much again. Let's see how all this merges into a research point of view, and I'd like to now invite Tara to share with us some of their experiences and some of the projects that have been proposed and started at the university, and see how she sees the government's helping in building a sustainable insurance model over a period of time. So over to you, Tara. The ball is with you now.
Thank you, Pranav, and thank you everyone for being here. Let me see if it's working. I want to start by talking briefly about how governments set their priorities when they're making investments. Appear to be having a problem. Aha. Typically when we work with governments, we discuss two objectives, two development priorities related to the investments that the government is making in agricultural insurance. We encourage them to be attentive, keep these objectives in mind in the way that they're supporting agricultural insurance, and make sure that the way they're doing it is effective in achieving these objectives. So before the disaster, we hope that by being insured, this enables people to take on additional productive risks. Before a disaster, farmers often mitigate their exposure to risk by avoiding risky but potentially profitable investments. An effective insurance contract can help to transfer some of that risk away from the farmer and enable them to make productive investments. In this way, governments, by supporting insurance, can also help support inclusive agricultural growth. And then, of course, more obviously, after the disaster, after a major shock, farmers in developing countries often adopt costly coping strategies, selling their remaining assets, reducing meal consumption, and other long-term, perhaps poverty-inducing things. These costly strategies also contribute to the intergenerational transfer of poverty if you reduce meal consumption for children under 5, for example. So we work with governments to try to make sure that their investments are working towards these objectives. In Ecuador, for example, the government was providing a 60% subsidy on a traditional claims-based insurance, and as the government implemented the program, they became aware of the high costs of that kind of implementation, and realized also that because of the complicated claims process, the farmers weren't really benefiting the way the government intended. The government reached out to basis researchers to see if they could investigate whether an alternative index-based type insurance contract would have provided more value for the farmers in the program. And so basis I4 researchers analyzed the data and realized that an area yield-based index insurance contract, for example, could indeed serve as a basis to develop a good policy that dollar for dollar would offer better protection for farmers compared to the existing system. Because the government is investing this with development objectives in mind, it's really important to make sure that it's achieving those goals. Basis researchers are continuing to work with the government in Ecuador to try to figure out how best to incorporate what they've learned into policy. What we've learned as we continue to work on these issues is we see right now two major ways that we think the government can play a role in working towards these development objectives. The first is to ensure that the insurance products that are going to market are of an appropriate and adequate quality. In order to see the development objectives, particularly the before the disaster impacts, people really must get protection from the insurance that if there is an event, they really do have a high probability of payout. Otherwise, the behavior won't change, the increased investments we're hoping to see if people aren't actually receiving adequate protection. Insurance is tricky because it's a technology with hidden attributes. Consumers can't really tell if its quality is good or bad until after a disaster actually occurs, which might not be for 5 or 10 years. So we need to do more to try to increase the confidence in insurance so that people are confident enough to pursue other opportunities. This leads to the idea that during the initial phase, the government might be able to use subsidies effectively to help encourage learning about the new product. Subsidies can help to stimulate the demand during this learning phase. So you want to be attentive to what the goals of those subsidies are and how you apply them, because that's very important towards working towards the development of a sustainable market. My slides don't want to move. Apologies. So one way to overcome the uncertainty about the quality of the insurance, the government can play a role in boosting consumer confidence much in the same way they do with other new technologies. Many governments certify new seed varieties that they can pass certain quality tests, certain minimum standards for quality. In this way, we think that perhaps the government could provide assurances to the target market of farmers that there is a certain minimum quality for the product being sold on the market, and at the very least, they won't be made worse off by buying it, and hopefully it will actually help them considerably. This might give confidence enough for the insured people to make those productive investments, such as taking out loans, before they observe a payout rather than waiting for a disaster every 5 to 10 years. Government can overcome these problems of market development in that way. I think that government certification could provide a way to give farmers confidence that the product really will come through for them, and hopefully then you won't have to wait 5 to 10 years to see the market develop until after payouts have occurred. In the same way, my slides are quite delayed. In the same way, to effectively use government funds, you can think of it as any new technology. If government funds are going to be spent, of course, and you've identified a high-quality product, now you need to think about how to get that product to the farmers and help farmers gain experience about it. When we talk about smart subsidies, we think of agricultural insurance the same as any new technology, such as new seeds. The farmers are really unfamiliar with the technology, they're unfamiliar with how it works, and by subsidizing it, you allow farmers to test the new technology at a lower personal risk. Short-term subsidies that encourage experimentation with the product can create a market that remains even long after the subsidies end. Though it's not an insurance study, we did a study in Mozambique where the government was subsidizing the use of fertilizer to try to encourage uptake of the fertilizer. they did a short-term 2-year subsidy that allowed farmers to test it, observe how well it works, and to better understand the value of the new technology. And because of that, they found that even long after the subsidy ended, uptake remained high. I think this is very similar to what Mathieu was talking about in Senegal, the idea that over time the insurance costs were gradually transferred to the farmers in the program. I think the idea that farmers need to learn more about how these new and somewhat unfamiliar technologies works, it's difficult for them to take on the risk of something they don't know whether or not works. So if you apply the subsidies in such a way that farmers can experiment with it and learn from it and then gradually phase it out, then I think that knowledge will empower them to understand the value and hopefully create a sustainable market. Okay, back to you, Pranav.
Thanks, Tara. You've kind of brought in an interesting aspect of talking about how subsidies need not be an ongoing exercise but can be short-term also, as well as looked at how governments can help in bringing about a good ecosystem in setting up attributes for various inputs that come in the products that are developed, and playing a role in kind of guiding the entire process forward. So that's an interesting way of looking at it. So we've actually looked at 3 or 4 different kinds of scenarios where the government can play a role, more so in terms of how it can be as a social safety net measure, how, and in India, for example, in India, an almost 97% subsidy can itself have a social security objective and move forward on it, and how subsidies or government interventions can actually start off a process and then the process moves forward on its own momentum in a short-term basis. So let's see what the audience has to say about this in building an entire sustainable agriculture index insurance market for the various countries. And we'd request the audience to respond on what they feel is the most effective way for governments to promote creation of a sustainable market for insurance. The options are bundling. We saw credit and compulsory insurance being bundled in India. Is that an effective way to build a sustainable market? Is it integration into social safety nets and various other measures in which insurance can be one of the mechanisms of building up safety and asset safety in that sense? Can that be a way forward for the government? The third, as Tara pointed out, short-term subsidies where you inject a subsidy and inject some money into an initiative, learn from it, and then let the momentum carry forward the program itself. That's the way. Or fourth, create a regulation, protect the customer, ensure that insurance is given out in a responsible fashion. Is that the best way for government to develop sustainable markets? You can of course say none of them make sense under the current scenario and go ahead and mark none of the above. So can we please open the poll for the audience now? So go ahead and please let us know if you feel bundling, whether it's the compulsory insurance that we saw, credit bundling there, or compulsorily bundling insurance with other inputs. Is that the way forward in developing a sustainable insurance market? Is it investments in safety nets and seeing how governments can help out? Is that the mechanism? Short-term injections, or having regulations and focusing only on regulations, the way forward in this? Let's keep it open for a few more seconds. Can we please close the poll now? Thank you. And the audience has given a very good and diverse response, but has stated that regulations for all of these and for the governments to function in an effective way are important. And of course, the consumer's interest needs to be protected. The other important part is talking about integration into the various risk mitigation mechanisms and social safety net mechanisms as a part of policy creation. Plus, running a close third, we have bundling and compulsory insurance being given out to the markets. So the audience seems to be feeling that while growth may happen, but for it to be sustainable, there are other mechanisms that need to be looked at. And of course, an initial injection of subsidies also finds some amount of favor with the audience. So with all these responses and with all these insights that we've seen from different parts of the countries and with different kind of players and different kind of implementation experiences, we'd now like to hear from you and get some questions going that can actually help us in the panel as well as the audience to understand more what the government can do. But before we do that, let's try and quickly summarize what we've been talking about and share a quick one-line concluding thoughts, and then we'll have the floor open to the audience. So Mathieu, let's start with you.
Yes, thank you. Amongst all the key messages that I highlighted, I just wanted to really underline that it's very essential for me that whatever business or product you want to scale up, that you provide evidence that your business is bringing added value to the population, the target population, and the country in general, if you want to have a strong involvement and commitment from the government. And for that, training at different level and involvement in the field and on the different steps of the government is key.
Thanks, Mathieu. So yes, that's very nice that the government needs to see evidence and it moves to see it going, and then the government can become excited about it. What are your views on it, Tara?
Well, I think my views are very similar to what we just saw in that most recent poll, is that we're seeing a lot of different roles for government to play, all of which have a lot of potential. These options are becoming increasingly clear, but I still think more work needs to be done to really better understand how these mechanisms work to best create a sustainable market for insurance and to maximize the development impact.
Okay, so it's still work in progress. There are some interesting and positive results, but we still have a long road to travel. Thanks. Yes, Vivek, now you've seen the market grow to millions of insurers and your own organization now covers millions of farmers. What's your view on how the government can help out and what more the government can do?
Well, I believe that government should play, in fact, a very important role at probably all the stages of this process. In fact, I believe that there can be altogether separate body to regulate agriculture insurance scheme in the country, which is currently being regulated by government at one end and probably the insurance regulatory body of India, because it cannot be treated as the traditional insurance. Secondly, instead, in addition to being the driving force, government can actually become active facilitators in educating the farmers about the concept of insurance, because in India, historically, insurance is seen as an investment kind of option rather than the risk mitigation system. So government should focus more on educating and assisting the farmers, and then planning and obviously execution of the schemes. Yeah.
Thanks a lot, Vivek, and thanks everybody in the panel. We've been receiving a lot of questions as we've gone along, and we'll quickly try and get into some of them. But let me assure the audience that we will keep the audience questions with us and share it with the panels, and the questions that we are unable to respond to, we'll get back to you soon after the webinar over the next couple of days. So please keep your questions coming, and don't worry if they haven't been asked in the panel right now. We'll certainly get back to you. So before, as we move forward, I think, Mathieu, there's the first technical question for you in that sense. There's Aksar from the ISU in the US who's asking that the indices that you talked about in Senegal and in Ethiopia, are they based on are they rainfall indices based on NDVI, or are they on-ground based, or are they both? More predominant, yeah.
Yeah, thank you. So in Senegal, we have the two. We have rainfall estimates satellite indices. So based on ARC2, it's data coming from NOAA satellite. So this is satellite, but we also have ground-based indices for crop-specific, such as maize and rice. We have installed with the other stakeholders a certain number of automated weather stations with GPS transmission. And in Ethiopia, we have an index that is covering for the first window only rainfall estimates, satellite-based, and for the second window, it's a combination of rainfall estimates and EVI. And we consider the highest level of payment.
Okay, so that works better for the customers, that the higher trigger gets it and the more payouts go. So, sorry, Mathieu, go ahead.
No, it's okay. I'm good.
Thank you. Thanks, Mathieu, and thank you very much for these inputs. I know you need to.
You're welcome.
Go, so thank you very much, and we'll continue with the questions, but we'll get back to you for with any more questions and wait for your responses. Thanks again.
Yes, please.
Vivek, there are very interesting questions coming out for the Indian example and for the new Prime Minister Fasal Bima Yojana that's just started. Peter Reede from the World Bank Group wants to know who actually underwrites the Prime Minister Fasal Bima Yojana? Is it the insurance companies? Is it the government who play the role in it? Who pays out the claims ultimately? Vivek?
Hi Peter. The underwriting is ultimately done by insurance companies. Obviously there's a reinsurance support to it, and the claims are thoroughly paid by insurance companies in this. Obviously there's a mark of 350% of the premium. That's a claim ratio. If it hits on a national level for any insurance companies, state would come for the rescue. This is the plan right now. But all the claims are to be paid by insurance companies. I hope I answered the question.
Okay, and since the premium is actually priced, the insurance companies don't have too much of a grudge in paying whatever is the valid, relevant claim to be paid.
Only in case of some catastrophe, probably government will at some case intervene and probably come for the rescue.
Has the government played a part under the old WBCIS scheme also? Like there's a limit of 350% that you said in WBCIS also. Was there a limit, or there the insurance companies had ran the rest
No,
of?
there was no limit in WBCIS. No limit in WBCIS.
So a related question to this, has the reinsurance mechanism changed, or have the reinsurers reacted differently in playing a role to take care of this expansion?
Firstly, obviously there was a huge shock as you would have already noticed that Indian market was at some very down levels, and now it has moved to 3 or 4 times of its actual limits. So yes, there was an initial shock in providing the capacities, but then while they understood that since actuarial price would be charged from the customer and from the farmers only, it's 2% which is coming for the farmers. The rest actuarial price will be paid to the insurance company. So I guess the reinsurers are pretty comfortable with that. So not an issue.
So you're saying the insurance market has enough capacity to actually insure 50% of all the farming communities in India in the coming 2 years, huh? With the government pushing steadily for it.
Yes, in the first year we are expecting it to reach around I just give you some numbers. There are 120 million roughly farmers in the country, out of which around 25 million used to take insurance till last year. And we are expecting this number to grow to around 40 million in this year. So that's around 35%.
Okay. Okay, we look forward to seeing how this growth is tackled, both on the insurance company side as well as at the government side. Tara, Peter has a question for you. It's a comment as well as a question wherein he asks that the problem with short-term subsidies is that the experimentation itself takes 5 to 10 years. Only when there are claims is the learning complete. So how sustainable or how short can these short-term subsidies be?
I mean, it really depends on the area. This is a problem we're encountering right now. We're trying to design a new study. And what we're trying to do is we're trying to implement the pilot in an area that has enough diversity of experience based on historical weather records, such that if you have, say, 5 or 10 different zones that have slightly different experiences, and a payout occurs, say, once in every 5 years, then during the study period, maybe not everybody will have a payout experience, but some areas will. And you can use that to inform the experiences of others, because your learning isn't necessarily only your own experiences, but you learn from the experiences of your peers as well, and observing their benefits, the benefits they receive, and understanding it in that way. So there are ways you can try to be creative to make it work. I mean, it is a problem without a doubt, but I think if you design things in certain ways, you can try to make it work. So we're looking at, in maybe 2-year subsidies, 3-year subsidies. I mean, it's going to have to be tailored to the environment and what seems appropriate under the circumstances.
Okay, thanks. Peter has another question for you, which says that could insurance simulations serve the purpose for experimentation at lower personal risk?
I think by simulation you mean, for example, games. This is something we certainly use. We get the farmers into an area, we have them play games, draw balls out of a hat to see whether or not there was a drought that year. We use that a lot. I think it's really helpful in helping farmers understand how the insurance works. And I think the comprehension that you gain from those kinds of experiences is essential. But there's also a trust issue. Insurance is kind of a weird concept in the way that you're saying, oh, please give me money now, and I promise if something bad happens, I'll give it back. So there is a trust issue that I think can only be overcome through observation of it actually happening and actually occurring either for you or for your neighbors.
Okay, thanks for that. Vivek, there's a question for you, and I think it'll be good for the audience to understand this process of seeing how the government can effectively play a role in driving these high level of subsidies. So it'll be great if you can spend 2 minutes to share with us what this entire deal is, how does the central government work, what amount does central government hold, then there's the state government, how the notifications are issued, and At what stage does the insurer enter the picture? So 2-minute snapshot from you would be gratefully useful for the audience of the issuing of the notification, the experimentation, etc.
Okay. Okay. So government actually invites. See, we have a federal structure in the country. So there's a central government which is actually designing the scheme in consultation with the state governments. And once it notifies the scheme to the state level, then state calls up all the insurance companies who are actually eligible for participation for bidding. So there are some predefined maybe term sheets in case of index-based weather insurance, or maybe some indemnity levels for yield basis insurance. So there's a cluster-based approach for any of the state. Like if I'll just give an example, there's a state called as Madhya Pradesh in India, which is comprising of 51 districts. So government divides whole state in maybe around 5 different clusters comprising of 10 districts in each cluster, and invites bidding from insurance companies. So once bidding is done, obviously the L1 is chosen for implementation of the scheme. Now the scheme has the structure like for this rainy season, these crops, only 2% of the sum insured will be charged from the farmers. And if the actual rate is around 10%, then the rest of the amount, that is 8%, the difference is being subsidized by state and central government in the equal part. So farmer just has to pay 2%, 4% would be shared by state government and 4% by the central government. And there's no limit, there's no capping on the actuarial price. So there are few crops, few districts which can have as high as around 30% of the actual rate, but farmer just has to pay only 2% in that. And same for the next season, that is the winter season, the crops, for the coverage of crops, the farmer just has to pay 1.5% of the sum insured, and the rest of the actuarial premium will be shared equally between central and state government. So once this is done, the sales is started. Since it is bundled with the finance, so all the banks are being approached by insurance companies to bundle insurance with all the loans they have passed to the farmers, and the premium is being submitted to insurance companies. And at the time of harvesting, the crop cutting experiments are being organized by state government in huge scale, and insurance companies are invited for overseeing or monitoring of those crop cutting experiments. So once that data comes in, the yield basis data comes in, the claims are accordingly paid to the farmers through banks or maybe directly. So that's how is the whole process of this scheme.
Okay, let's see how the process goes. It being the first season, so
yeah,
it'll be interesting to see this process through. Thank you for this explanation. We've now actually entered the last 5 minutes of our allocated time, and we have 2 very interesting questions that we'll just quickly take. One is from Yoel Gonzalez, who asks, and we can take it in the panel, on how can you implement index insurance products in countries with poor data availability and poor infrastructure? What is the minimum needed? Any examples that the panel may have? Tara, any quick reaction from you?
Yeah, I'm trying to think. I'm thinking through my memory, and I think the important thing is that you have. It depends on what kind of index you're trying to implement, but it's important that you have enough data that you can state with a certain degree of confidence that there is a high probability of payout when an event occurs. And I think that differs based on conditions and severity of the events and what exactly it is you're trying to ensure. So I'm not sure I can give a black and white answer. In terms of the infrastructure, that's one of the main reasons we consider things like satellites. The infrastructure demands are a little bit less in those kinds of situations. Obviously, traditional insurance, if the infrastructure is weak, can make the insurance prohibitively expensive. And then rainfall-based insurance, the building and uptake of rainfall stations, combined with the fact that as you move further away from a rainfall station, the strength of the index weakens dramatically, so you need quite a high density. Satellite has fewer of those problems, and I think it's one of the best options, depending on the circumstances. It's one of the best options to consider when you have problems with infrastructure in that way.
Thanks, Sarah. And Yuval, just a few quick inputs. Yes, it is a challenge to design index insurance when data is poor, and it also depends upon what kind of data is poor. Is it the historical data that is not there, or is it the current data collection availability that can be a challenge? So yes, it does become a challenge to design insurance products, index insurance products, with poor data and poor infrastructure, and what it effectively leads to is a bit of a slightly high-priced product. But that's not to say that it can't be designed, and as Tara mentioned, there are newer technologies that are coming up that can actually populate data and even create back-end data in the absence of historical data. So there is modeling that is now being done that can fill in data gaps and create stuff from there. We will share some examples from our experience, Yoel, on how this index insurance has progressed in various countries, and perhaps some lessons can be drawn from there. So we'll certainly try and get back to you quickly, Yoel. I'll quickly take the last question, which is targeted at you, Vivek. Roland Steinman wants to understand, why do you recommend that a separate body can help with the regulations and focus on agriculture insurance? Is the current infrastructure not enough, and why do you see there the need for additional work from the government side on this?
Sure. Thanks for the question. See, the current scheme is actually designed by the central government with a view that most of the farmers in the country would come under the purview of the scheme. But as we go ahead, and we have experienced it in past as well, that there is too much government intervention in yield basis product, because obviously government is also there, is having some stakes while there is a question of farmers. So I'll just give an example of RBI in India. I mean, that's the Reserve Bank of India, which is obviously a regulatory body of the banking system in the country, but then it is regulated by, it is formed by the government, but still it has some powers to say no to government. And finally, what it helps in development of the sector in the country. So probably that is one of the reasons that we need some regulator which can actually say no to the government when actually government is going wrong somewhere. We need a third party which can actually oversee all of this a huge scheme, which is probably going to be the second largest product line in the country in the insurance sector in coming few years.
Okay, so that's interesting. You're saying you need a monitoring mechanism that can actually ensure the schemes fulfills the objectives and takes a path that it's supposed to take, and not
that it is self-sustainable. The scheme should be self-sustainable.
So for sustainability's sake, you will need a monitoring authority that can keep it on its right path. Also added to this is the fact that there are multiple regulatory bodies involved in this. So there's the Ministry of Agriculture, of course, but there's also, as Vivek pointed out, the Ministry of Finance that is involved. So I think what Vivek would also like to see, Vivek and other insurers would also like to see a single point contact where some of these issues and coordination between different ministries, and we heard Mathieu also talking about which ministry to go to. So a single ministry that can help, and not perhaps a ministry but a division or a department, which can be a single clearinghouse for interactions for insurance schemes, can actually be carried out. Now, whether we call it a separate body or a mechanism within the current setup, that needs to evolve over a period of time. So I think on this note, we seem to have covered a fair amount of ground in the ways the government can actually help, and what have the implementers learned and want more from the government from, and as well as have seen the government providing benefits to help in growth of the insurance programs, the agriculture index insurance programs in various parts of the world. So on this note, I'd like to thank the panelists for their contributions, as well as the wonderful audience for all their inputs and questions that have come in. I'd like to assure them that any questions that have got missed out as of now, we will collate them, get our panelists to respond, and certainly get back to you in the next week with responses to that. And I'd like to thank certainly the USAID and the Basis I4 program for this webinar, as well as the Global Index Insurance Facility of the World Bank Group, which has helped tremendously with these webinars and the dissemination series. And look forward to having all of you back again for our next webinar. So please keep a lookout for our newsletters and emails, as well as feel free to write to us at impactinsurance@ilo.org. Thank you all once again, and look forward to seeing you shortly on our next event. Thanks.
Thank you.